Hello everyone, welcome back to the Road to Retiring channel. I hope you're doing well. Looking at the screen, you can see the comment from Jodier left in one of our recent videos, and today we're going to be looking at the second stock in that list, Enphase. Now Enphase is a really interesting company with some seriously impressive growth over the years, and it's had a big drop from around $330 down to currently at $196. So we're going to look if that's at a good value now and what the future value of this could be. If you enjoyed this content, please do drop the video a like, subscribe, and let me know in the comments down below any other stocks you're interested in hearing my thoughts on. So to start on Enphase, let's look into it. So you know that I like growing profit margins, and this graph was absolutely beautiful when I saw it. Quarterly, you can see that this orange line, this profit margin, is super steady and growing really nicely. And I thought, let's have a look at what the risk with this company is. So to do this, I like to look at 4 metrics: earnings growth, revenue growth, operational cash flow growth, and equity growth. So starting with the earnings growth, we want to see levels above around 10%, and we can't judge this until 2018 when it became positive, because it was actually negative before then in terms of earnings. But the earnings have been positive since 2018, and you can see they've grown really nicely from that point where they started being positive at $0.10 per share in 2018 to current levels at $4.62 per share in 2022. Now, this forecasted growth is also amazing, expecting Enphase to hit $11.12 per share in earnings in 2026. So there's some fantastic growth opportunity here with this company. And that's in earnings, and it's a similar picture in sales. If you look, they've grown fantastically from 2015, where it was trading at, they were reporting revenue of $357 million, to now in 2022 reporting revenue of $2.33 billion. This is way above that 10% benchmark we like to look for, and also the growth in the future is just as impressive. From that $2.33 billion level now at the end of 2022, they're expecting to report $5.76 billion at the end of 2026 in revenue. So again, some fantastic revenue growth. On top of this, I said we like to look at equity growth and operational cash flow growth, and they paint a similar picture. If we look at cash from operating activities and we change this to annually, you can see since it's become positive in 2018, it's been absolutely booming, and now at levels way higher than it was in obviously 2018. The growth is fantastic in this cash from operating activities and in equity too. If we look at the balance sheet, you can see that the equity has grown really nicely from 1.3 million in equity in 2016 to 825 million in 2022. This company is growing at an incredible rate, and its future projections for continued growth are very interesting. Now, I want to have a look that the management are making effective decisions. So to do this, and looking at their investments, we look at return on invested capital, and you can see consistently since 2019, since they've become positive, this return on invested capital, since they become profitable, you can see it's way above that 10% benchmark we like to look for. It was 68% in 2019, 30% in 2020, 15% in 2021, and 23% in 2022. So again, really comfortably over that 10% benchmark. So I'm thinking it's looking really good in terms of the risk. The one thing which is slightly a put off is the fact that their current long-term liabilities are around double the size of their current long-term assets. However, because their short-term assets are so largely above their liabilities, they would be able to cover this difference between their liabilities and assets in the long term with their short-term assets. So it's not as major a factor in terms of a worry, but it is still something we'd like to see resolved moving forward in terms of them picking up more long-term assets or maybe reducing their long-term liabilities. And in terms of their debt level, well, currently their debt's at 1.31 billion, their free cash flow is sitting around 700 million, and we like to see free cash flow pay off debt within 3 years. You can see that they can pay this off within 2 of their free cash flow, so I think they're pretty healthy in terms of financial health, and they do have a nice portion of cash to back up any additional help that they'll need to pay off debt. So I think they're okay in terms of a financial position. The only major risk that I see with this company is simply underperforming analyst expectations in terms of growth rates. Now these growth rates are super high. You can see 2022 from $4.62, expecting them to hit $11.12 in earnings per share in 2026. that is a really ambitious growth rate prediction from the analysts, and I think the only risk there could be that they underperform these slightly. So I'm going to show you how we've incorporated that into our valuation now. So moving over to this sheet, here is Enphase. You can see the analyst 5-year estimated compound annual growth rate. Now this is the Yahoo Finance one. This is next 5 years per year, 20.05%. So that's where we've got that from. But the analyst growth rate is actually higher if we were to look at the TradingView one. You can see here it's $4.62 in 2022 up to $11.12 in 2026. Now at 20.05%, that only takes you to $8.87 in 2026. So on TradingView, the analysts are expecting something more along the lines of 27%, taking you to that $11.10 mark in 2026. Now personally, I want to be safe with my investment. I want to make sure I'm getting it at a good price, and so because of this, I'm going to go with the one which feels a little bit safer, because if this is the one that's accurate, then we're getting a bargain if TradingView are accurate. But if TradingView is the one that's accurate, then and we think we're getting a good price, it might not actually be a good price if the Yahoo Finance one is the accurate one. So we're going to use this. Our discount rate, we've gone for our standard 9.5%, and I said the only slight margin of safety was because their long-term liabilities are greater than their assets, and because they are such ambitious growth rates. You can see we're using 25% for the revenue growth. This could easily be underperformed quite significantly, so we just added on a tiny margin of safety to our standard 10%, bringing that to 15%. And lastly, we have a 2% share dilution for all of our estimates here, and that is because they have been issuing shares at a pretty aggressive rate, although it's started to slow down in recent years. If we look at their total common shares outstanding here and we look annually, you can see they were issuing loads and loads of shares. From 2016 to 2019, their total common shares outstanding basically doubled, but this has slowed down a lot, and they've only increased this from 123 million in 2019 to 136 million now in 2022. So I'm expecting the growth to slow down, but a continued sell-off of shares, which would bring a 2% share dilution, bringing the share count to around 150 in 2027 is what we've incorporated for in case that they do continue to dilute their shares. So based on that, with that 5-year analyst estimate of 20.05, the current EPS of $4.62 on a non-GAAP basis, we've gone for price over earnings multiple of 23. You can see the non-GAAP price over earnings of Enphase is currently 41.89. Now this is where Enphase starts to fall off a bit as a company. The valuation right now is super high, and you can see the 5-year average is all the way up at 80 compared to a sector median sitting around 18. So you can see there's a crazy difference in terms of compared to their sector, and I would expect a premium for a stock like Enphase because it's got such high growth rates, but a premium as high as 41 just seems a bit too much for me. I wouldn't be a level I'm comfortable predicting, and a level where I would feel more comfortable is around 23. There's still a slight premium from that 18 sector median, but it's nowhere near the levels we're seeing in terms of what we're currently seeing at 41.89. So based on that, that would bring us a fair value in 2027 of $239.98 and a fair value right now of around $129.58. So we'd be looking for quite a big drop off in terms of the price to earnings calculation. However, as I said, if this does meet TradingView's expectations, you'd be looking at an earnings growth rate of around 27%, and with that, your price over earnings multiple would be higher because your PEG ratio tends to be just over that 1 mark is where I feel comfortable. So that may then trade at around 30 if the earnings growth rate was 27, and then suddenly it's 14% undervalued. There's a 14% upside, and the 2027 price is going to double from the current levels. So obviously, this could change massively depending on how fast earnings actually do grow, but we've got to make sure that we're getting it at a bargain and we're not going in at this high price in case it doesn't meet these expectations and actually hits the lower expectations from analysts on Yahoo Finance, and then the price of the earnings multiple is not likely to be as high, and it's probably going to trade around 23, 24, maybe higher, and it could easily never come down to these price over earnings multiples if it continues to have crazy earnings growth rates. But we want to make sure that if we are getting it, we're getting it at a nice price like this. So that's what our calculation is for the price over earnings. For price over sales, we've gone with the revenue growth rate of 25.3%. Now this is what is laid out here on TradingView, from 2.3 billion in 2022 to 5.76 billion in 2026, which is what we have laid out here. Now with this, we've gone for a price to sales multiple of 6. You can see the price to sales was really steady around 1, 2 for ages, even really low, 0.1, 0.3, and then back up into the 1s in 2018, and then suddenly it started to boom. It traded steadily around those levels at 5, 5.4, 5.9, went up a little bit to 8.74, and then as the price jumped, obviously the price to sales jumped with it, went to crazy levels around 31.2, and it has been falling ever since. And I would expect this to continue to fall, but not reach the levels that we previously saw prior to 2018, where it was really low around 0.1, 0.3. You can see it stabilized a little bit around 2019 at a price to sales ratio around 5ish, and then going up to 8, and so that's a level I feel more comfortable at it sticking at. And you can see obviously the sector median's quite low, but for price to sales this can be very different from stock to stock, and 6 is a level where I feel comfortable. And based on that, the fair value for this would be $154.70 with a 2027 price of $286.50. Now lastly, the cash flow, we're going to have it growing similarly to earnings. They have a similar relationship. Operational cash flow is made up of net income, but then it includes other things such as depreciation and non-cash items. So we're going to assume that it grows sort of in line with the earnings growth rate, but at a slightly faster rate at 22% compared to 20%. And then we're going to account for operational cash flow multiple to have a little bit more of a premium on it, as it has this faster growth rate, and because you can see the sector median price to cash flow is slightly larger than the price to earnings non-GAAP. It's about 2 larger than it, at trading at 20 instead of trading at 18. So we're going to have that increase at 25 instead of at 23. And based on that, the fair value based on the cash flow is actually going to trade at $180.30 being the fair value, which is really close to the current prices, only needing an 8% drop from these levels, with a 2027 price which is actually a really nice return at $333.93. If we take the average of all of these, this brings us a fair value at around $154.86 with an average 2027 price of $286.81. So that's still around an 8% return each year if you were to own it right now at these market price levels, and it did hit these prices, which isn't bad at all. And considering this could be much higher if we see larger growth rates that are expected that compared to the ones that are on Yahoo Finance, if we did see those larger growth rates, let's say it was 27% and 30 price to earnings multiple, that could then easily be a 30% operational cash flow growth with a 35 operational cash flow multiple, and suddenly the fair value is $241. So obviously there is potential for massive returns with this stock, and it is a very interesting one. But for me, I feel comfortable at the lower growth rates, where I want to make sure that if I am going with one of these analyst predictions, I'm going with the one that's safer, as I want to account for them both being right rather than just one of them being right. So if they are both right, then that's amazing. That brings us a fair value $154.86. Let me know if Enphase is a company you're interested in, and if there are any other stocks you'd like me to go over. Please do drop the video a like and subscribe if you're new. And yeah, this is a stock I would love to own, but right now I'd just like to see it drop a little bit more. I appreciate you watching, and I'll catch you in the next one. Bye guys.